reorganization value attributable to the 3 5/8 will be well north of the current dollar price of 53. There is no Forest City parent company debt outstanding that is senior to the 3 5/8, and the $6.8 billion of secured obligations outstanding are all non-recourse debt issued by Forest City subsidiaries, not the parent company. In other words, a creditor owning subsidiary-issued debt can look only to the individual property for repayment, not to any assets of Forest City as a parent company. So, in effect, the 3 5/8 become a blanket second mortgage, where to be a performing loan, not all, but only a number of Forest City's vast empire of prime real estate assets has to throw off cash to the parent company. It is possible that Forest City, as a parent company, could incur new debt that would be senior to the 3 5/8. This could be a problem, but it is lessened by the probability that Forest City as a parent would receive the cash generated by the incurrence of this new debt, and that such cash would be invested profitably. We discuss many of these distress investing risks in Chapter 12. We feel strongly that understanding distress investing is extremely helpful to analysts deciding to focus on common stock value investing. It is essential when investing in common stocks to learn to benefit from the use of disclosure documents, to understand capitalizations, and to appreciate the fact that, certainly in 2008 and 2009, common stocks can have little value regardless of price if they are issued by companies that are not creditworthy. Interestingly enough, even the best of value investing literature, for example the 1963 edition of Security Analysis, Principles and Techniques by Benjamin Graham and David Dodd with Sidney Cottrell, leave much to be desired in terms of credit analysis. Further, Franco Modigliani and Merton Miller, two eminent economists, received a Nobel Prize for postulating, assuming that managements work in the best interests of stockholders, corporate capitalizations are a matter of indifference. What utter nonsense. This book, we hope, has lessons for value investors who invest only in the common stocks of strongly capitalized companies. Probably the most striking thing about the distressed area is that so many of the operative facts in distress are 180 degrees opposite from what the conventional wisdom says the facts are, even among sophisticated professionals without any distress background. In 1979, one of us served as financial advisor to the Kemeny Commission on the accident at 3 Mile Island, a nuclear facility in Pennsylvania. Subsequently, that same author was retained by Long Island Lighting to explore bankruptcy scenarios for that troubled electric utility. In 1985, he wrote a paper about what would happen if an electric utility actually filed for bankruptcy relief. In that paper, he compared what was likely to happen, correctly as it subsequently turned out, with what the conventional wisdom was, and unfortunately still seems to be, as postulated at that time by Arthur Young and Company, a public accounting firm, Morgan Stanley and Company, an investment bank, and Milbank, Tweed, Hadley and McCloy, a law firm. The wrong postulates of the conventional wisdom as put forth by these professionals at the time were about as follows. The three institutions wrongly believed that there would be a loss of tax revenues for state and local governments. There would be a loss of state pension fund investments in securities of the affected utility. There would be higher levels of unemployment in the state. There would be a loss of business confidence in the state. There would be uncertainty as to future levels of service by a bankrupt utility. There would possibly be increased rates for utility customers over the long term. There would be an increase in the costs of capital for other utilities in the state. A trustee would replace management. Operating costs would go up. Investors would shun acquiring the securities of a bankrupt utility after it was reorganized. It seems to us that the 1985 conventional myths are being reiterated at the end of 2008 in looking at the proposed government capital infusions into the automotive Big Three, General Motors, Ford, and Chrysler. In order to be viable, these companies have to be able to sell cars and trucks. Their current levels of financial distress, widely publicized, have already tainted these companies in the eyes of the consumers who are potential car buyers. It seems a stretch that Chapter 11 filing would realistically cause the taint to be greater than it already is. Further, the three have experienced dramatic losses in market share over the past 30 years. With or without Chapter 11, the Big Three